All right, so day 3. Congratulations on completing the first 2 days. Now, on day 3, today we're going to go over the different trading terminologies. When we talk about ticks, when we talk about pips, points, lots, leverages, margin, everything will be explained in this video. It's going to be a pretty short video, but if you do, I promise you, if you don't understand this lesson, the rest of your journey will feel like reading a language you don't speak. This is your trader's dictionary. Save that video if you have to. But if you go in any server or community and you don't know what you're talking about when they talk about ticks, pips, distance, margin, leverage, like you're gonna be confused, all right? It's like the words that make up the financial world you're about to step into. All right? So let's go through each one carefully and build this solid foundation. So let's start with ticks. What is a tick? So ticks are used in futures markets, by the way. So you know what? Actually, I think I'm gonna take some notes as I'm explaining, right? So it can be a little more interactive. So ticks are used in futures markets, which is what I trade, by the way. If you guys forgot. All right. So let me just write it like this, bro. So the basic definition of a tick is basically it's the smallest unit of price movement in the futures market. Think of it like if a price is a ruler. So think of it as a ruler, and if you look at the ruler, there are different lines, right? There's a line right here, 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 and so on and so forth, right? Now, a tick is the smallest line on that ruler. In this case, it would be like millimeters, right? So let's say in the S&P 500, the size of a tick is 0.25. We know that on a ruler, a millimeter is 0.5 centimeters, right? That's what am I saying, 0.5? A millimeter is equal to 0.1 centimeters. That we agree, right? Now, in the S&P market, the size of a tick is equal to 0.25. So if the proof it meaning that when the price moves, it moves in steps of 0.25. So let me give an example just so you're not confused. If the price, let's say, of ES is at $5,000, 0.00 currently, if it moves up by 1, well, essentially it will be at 5,025, and that distance over here is 1 tick. Simple as that. If it moves to 5,000, if it moves to 0.50, that's 2 ticks, and so on and so forth. All right? Simple as that. There's really no complicated aspect to it. Each tick is equal to 0.25. So you also have to know that, 1 tick is equal to 12. In profit-wise, it means 1 tick is $12.50. All right. This is something you don't necessarily have to know that. There's oftentimes going to be a tool that just shows you the profits, but just for general information, 1 tick is valued at $12.50. Okay, so this is how much you get per tick, all right? So 2 ticks is $25, 4 ticks is $50, 10 ticks is going to be $125, all right? But keep in mind that the tick size is 0.25 on ES. So if you bought at $5,000 and you sold at $5,001, let me go ahead and note that down. If you bought at $5,000 and now you decide to close your position, so it goes this way, right? And you decide to close your position at $5,001, that's the move of 4 ticks, right? Because 25 times 25, the distance of 0.25 enters 4 times, right? That's the difference. So essentially, these 4 times would be called 4 ticks, right? So the distance for $1 is 4 ticks, all right? So what about when we talk about micros? Because, we're going to talk about micros also when we trade futures. There's micros and there's minis. So when we talk about micros, So oftentimes what you're going to see on the chart, let me go ahead and take a clear here. So oftentimes when you see on the chart, there's going to be MES. This stands for micro, ES. And there's just going to be ES, which is just mini. Yes. So this one is much bigger, by the way. This one is bigger than this one. Okay? So what does it mean when you talk about micros? So on micros, one tick is equal to $1.25. So what that means is essentially it's that oftentimes new traders would trade on micros because it's much safer. The losses are smaller and more manageable. Because we also, if I just give you a comparison, one tick here, as we know that what's going on here? One tick here on, what am I saying? I confuse myself. But essentially, one tick on normal minis would cost you $12.50. So it's the same exact chart, except that you're gonna be able to manage less. Let me just give you guys an example, just so it can be a little more clear here. So if I go to Top Step, and let's take NASDAQ actually. So if I go ahead and look at NASDAQ, as you can see, I'm trading the regular NASDAQ future market, right? Now, I could also go to, like ES, I could go to MNQ, which is micro NASDAQ. Now, the thing with micro NASDAQ is that instead of costing me per tick, instead of costing me $12.50, instead of, it goes both ways, by the way. Let me stick to ES actually, just so I don't confuse you guys. So instead of generating profits of $12.50 per tick, I'm actually getting less on micro ES. I'm actually going to generate $1.25 per tick. So it is much safer for, especially for new traders, to trade on these kind of markets, just because the risk is less important than if you were to trade on regular ES markets. It's just basically you're trading on the baby I wouldn't say the baby account, but you're trading on the baby market. All right, it's beginner friendly. It's often used if you have less capital. That's all I'm trying to say. All right. So really not much that is complicated here. Again, if you have any questions, these are just some measures that you need to know. If you don't understand, listen, you can always ask me questions, but I gave you the numbers. Now let's jump to what is a pip. So pips here are used in Forex. We don't talk about pips when we trade futures, but in Forex, if you want to trade Forex, of course, I'm also going to talk a lot about Forex. Even though I trade futures, a lot of the things I'm going to mention are going to be about Forex as well. So if you hear about pips, a pip is the equivalent of a tick. So I said tick. That's crazy. So a pip is the equivalent of a tick, except that it's in the Forex market. All right. So it's the smallest price movement most currency pairs can make. So for example, if I go to the Euro USD, so the value of the European well, I'm just gonna say European currency compared to the US dollar, one pip. So let me just give an example right here. If we go ahead and look at a price, so if the Euro USD moves from, let's say, 0.50 all the way to 1.051, we will say in this case that this is one pip. All right. So one pip is equal to 0.0001 in most currencies. It all depends. There's, gold's gonna have a different movement. But if you go to a currency, because gold is not a currency, gold is a metal. But if you go to most currencies, one pip is gonna be equal to this number right here. So 1 pip is actually equaled to, on average, this is just an average, this is just a random fact, you don't have to remember that, but it's about $10 per standard lot, per lot, because on Forex, I know they trade with lots. We're going to talk about lots in a second. And a lot is around 100,000 units. You don't need to know all this. This is just, all that's in green is just information that I'm giving you. But all you should know is that 1 pip is equal to 0.0001 in most currencies. So while we focus on futures trading, it's still good to know what a pip is in case you want to explore Forex later, or if you want to start with Forex. I'm just giving you the basics right here. All right. Now, what is a point? So a point, we talk about points both in futures and Forex, actually. I don't specifically use points, but it's still a good thing to know what it is when someone talks about it. So, 1 point on the ES market, for example, let me just write ES. So 1 point is equal to 4 ticks, right? So if we go to delete the example, but 1 point is equal to 4 ticks. So 1 point would therefore be, just to give you guys a number, it would be equal to $50. So it's $50 per point on ES, that is. Just a random number, but 1 point is equal to ES. So a point is just a larger price movement. It's made up of ticks or pips if you trade Forex. So if someone says I made 10 points today on ES, essentially that means that he made $500 profit per contract. And I'll talk about contracts eventually, but basically if we say $500 profit per contract, that means that if he had, let's say, 2 contracts in position, he made $1,000. If he had 5 contracts, he made $2,500. All right, so this is why you must respect points, if you can make or break your day. All right, so now let's talk about the lots. So lots are often used, I used to use this a lot. We were talking about lots when I was trading Forex. And so a lot just refers to the size of your trade. Think of it as your position size. So when you trade Forex, okay, let me go ahead and draw it over here. When you trade Forex, we will say that 1 lot is equal to 100,000 units of your base currency. What does that mean? It means if I'm trading, let's say, let me go here to USD CAD, and I'm buying, oh my goodness, I don't need to create an account, and I decide to enter for a buy position with one lot, I'm essentially buying this 100,000 times. Okay, so that's all it means. If you enter with 5 lots, that means you're buying this at $1.37. You're buying this at 500 times. You're buying this 500,000 times. All right, that's all it means. Simple as that. So 1 lot is equal to 100,000 units of the base currency. Now, if we talk about futures, because we can still use lots in futures, but I actually call it something different, and it's actually going to be called a contract. All right, so in futures, we don't talk about lots. You're not going to hear anyone talk about a lot. In futures, you're going to talk about a contract, but it means the same thing. So in futures, 1 lot is equal to 1 contract. So if I go back here to, for example, here, you're going to go ahead and see that when I traded, let's say, NASDAQ, I don't know if it's going to show me trades. So you're going to see here, there's a 2 right here, and I traded with 2 contracts to make $1,500 today. So essentially, I could say the same thing, that I used 2 lot size to make that position. That's all it means. It's the exact same thing as Forex. Now, if you go to micros, if you guys already did the math, one lot is also equal to what's called one micro contract. But one micro contract is equal to 1/10 of a contract. Hence why you saw that the price here, let me see if I can still have it. Oh, I deleted it. That's a shame. You know, remember last time, a few minutes ago when I said that if you were trading ES, one tick would give you $12.50. And if you're trading micro ES, one tick would give you $1.25. That's just the statistic right here. So one micro contract is equal to 1/10 of the contract. That's all it means. All right. So these are just numbers for today. It's a lot of information. Probably won't remember all of this today, which is fine. It's just things to keep in mind for the future. All right. Now let's talk about leverage. This is where it gets interesting. What is leverage? So leverage is it lets you control a large amount of money with a smaller deposit. Let me give you an example. So like if it's like putting down a security deposit to rent let's say you want to rent a car. You put a security deposit of $100,000. Except that in trading, you get to profit or lose based on the full $100,000 as if you owned it. You know, when you buy a car and the car costs $100,000, they're going to ask you to make a security deposit to rent the car, for example. So you're going to put, I don't know, $20,000 down to still drive the $100,000 worth car. Trading, it's pretty much the same thing. You trade, except that you get the profit based on the full $100,000, even though you didn't put the full $100,000. Let me put that into example. All right. So one ES contract, roughly represents $200,000 in value. But you only realistically need $500. Let's be honest, you roughly need $500 to $2,000 in your account, in your actual bank account to control $200,000. We'll talk about leverage because that's actually 100 times, 100 to 400 times your account size. So with $500 to $2,000, you're able to control $200,000 in the market. That's 100 to 400,000 to $400 dollars. It's 100,000. It's bro. Let me rephrase. I'm speaking too fast. So let me rephrase. So with $500 to $2,000, you're able, in the market, you're valued. You're able to control $200,000. We will talk about leverage in this case because it is a leverage of 100 to 400 times. So you're able to control 100 to 400 times the size of your account. That is leverage. And you're going to see that in crypto as well. There are these huge leverages that you can have. You can have a leverage of 1,000. And oftentimes when you're going to look for a broker or an institution to trade with, they're going to show you, let me go ahead and go over here. They're going to show you, they're going to say leverage. And so the leverage of the account, usually accounts go to 1 for 100. But all that means is that for each dollar you have, it is valued at $100 in market. All right. Now there are some institutions that are going to give you 1 to 1,000. There are some that are going to give you 1 to 50. And you're going to see some of them go and tell you 1 to unlimited. You want to be really careful with these, okay? While you can make a lot of money, you can also lose it really, really, really quickly. And 1 to unlimited is what you see on YouTube where these guys they flip $100 to $100,000. This is ridiculous. You guys should not do this. I understand that trading is nice and you know you can make a lot of money really quickly, but you obviously do not want to be one of these guys that just At this point, it's called gambling. You know what I'm saying? So I would really recommend to stay within the 1 to 100 to 1 to 50. These two are like the best. All right? 1 to I've seen 1 to 30. This is oftentimes going to be used by people that want to do swing trading, so they're trading over multiple days. But unless you're that kind of guy, I really want you to stick to 1 to 100 and 1 to 50. All right? So this is all leverages. So the pros of leverages are that, small moves can make you a lot of money. You can have a lot of gains, but small moves can also generate big losses. That's all I'm trying to say. So you do not want to trade on 1 to unlimited. This is just gambling at this point. All right. Now, leverage it's fire, okay? It cooks your food, but it also can burn down your house if you don't know how to risk manage, and it's you have to be really intelligent and smart with that. All right. Now, lastly, let's talk about margin. What is margin? So margin is just the minimum amount of money you need in your account to open or keep a trade open. So oftentimes you're going to see that you have an initial margin in your account. So the initial amount of money you have. So what it means is just that it's just the amount that you need to open a trade. And then you will have a maintenance margin. And the maintenance margin is the amount that you need to keep the account open. Now, I don't have a live example at the moment, just because I locked out my account. But let me go ahead and see if I can show you still some kind of way. Okay, so you can see here the maximum loss limit is when my balance hits. Let me go ahead and show you with an arrow. The maximum loss limit is when my balance hits $0. I'm still currently at $5,000 in the account in profits. Whenever I hit $0, my account will get shut down. That's all it means. So if the initial margin is $0, the maintenance margin, let's say let me give you another example. Let's say your broker is Top Step, like me, okay? Your initial margin is, let's say, $1,200. Okay, this is the amount that you can trade with. The maintenance margin is, let's say, $1,000. If your account balance drops below $1,000, if you lose $1,000 while the trade is running, your broker will automatically close your trade because this is called a margin call. You don't have enough money. In funded accounts, even if it's even stricter, right? You have rules like drawdown limits, no margin, not just margin. You have but we'll cover that soon. But if you go below your margin, your maintenance margin, they will automatically close your trade because they deem that you no longer have the sufficient amount of money to keep the trade open. All right, it's just a safety call pretty much, so you don't lose your whole account. You would still have $200 left. But now keep in mind that you need a certain amount of money to open a trade. So if you have $200 left because you lost $1,000, you can pretty much get little to no money. And you would probably have to either redeposit some money into your account or just start over if you're on a trading account, on a funded account, or whatever prop firm account you're using. All right? So, the reason why, let me end on this, all right? I'll end with this, and then I'll give you guys what the Bible says about all of this, right? So, the reason why, let me write this here. The reason why new traders blow their accounts, and I don't want you to be a part of them. Many people fail. It's not because they're bad. They fail because they don't respect the numbers. They say that, especially when you're on funded accounts, they say that statistically 96%, or I think it's 90%. 90%, at least, I know it's in the 90s. 90% of people that take exams to get funded for 100,000, 50,000, they fail. And the reason for that is because they think that one take isn't much. But it goes quick, guys. It goes really quick. I know that I said that one tick is $12.50. And you think, oh, one tick is not that bad. But 10 ticks is $125, guys. And they think that they can manage losses, crazy losses. You see some people lose 14, 15, $20,000 in a single trade. And that's the reason why they blow their account. But we're going to go all through that, all through risk managing. You have to understand the value of all of these metrics. Okay? The second reason why most of them trade is because they trade big sizes. They trade big contracts. Instead of trading, you see me, bro. I only use two to five contracts. Even the 5 contract, I only kept it for $100 profit. Oh, you can see I got a negative trade here. Lost $50 with 5 contracts. I was kind of stupid and reckless because I was trying to finish the day early. But you see, you can make with 2 contracts, risking less, I can make just as much, if not more. Okay? You don't have to use big lot sizes. You don't have to use big contracts. Okay? You don't need to. It's like going to the casino. You have the option to either gamble with $1,000 or gamble with $100. If you lose $1,000, it's gonna hurt you much more than losing $100 and still have 10 more tries or 9 more tries in this case, right? So you want to trade with a reasonable size. The other reason why traders blow their accounts is because they ignore volatility, which is what we talked about yesterday. When the market moves fast, you have to have a certain target that respects, of course, the market structure, the market direction, but don't expect to make 1 million in a single trade, guys. Be honest, be realistic, okay? The market moves in a certain way based on certain events, based on certain decisions that are out of your control. Remember what I said yesterday, you cannot control the market. So most people ignore volatility. They try to trade when there's no volatility, and they lose their money because the trades are not moving fast or they're moving in different directions. And they trade when there's too much volatility, and because of no proper risk management, they end up busting their account. They end up losing all their money. And that brings me to the next point. Most people blow their accounts because they don't use stop losses. They don't know when to stop. They don't know when to exit the trade. They're negative 1,000 and they start praying because they know for a fact in their head, apparently, that even though the market decided to absolutely obliterate their account, oh, well, you know what? At this point, I think it's going to go back up and reach that zero. And even when it reaches back to zero and they have the chance to exit the position, they think to themselves that, you know what? It reached zero. Why not go higher? I will keep my position open. This is just pure greed, and this will kill you. Okay? You cannot be a trader and be greedy. Okay? And the other reason why traders blow their accounts is because they confuse confidence with skill. Yes, you can be confident in your trade, but you also have to acknowledge that sometimes your trades are not going to work, or the market's going to move it's moving in a different way than you expected. Confidence does not mean that the trade is going to work. You need to discipline yourself. Okay? That's all I had to say. All right? So, what does the Bible say? What does God say about all this? Stewardship over speed. So, it says in Luke, let me write this down because I know I always write this down. It says in Luke 14 to 20, verse 28. Okay? It says, suppose one of you wants to build a tower. Won't you first sit down and estimate the cost? Before you build a tower or a trading career, count the cost. Don't take trades just because they look good, just because you want to make a certain amount of money. Ask yourself, how much could I lose? How much is each tick worth? Can I afford to take this trade? Can I afford to lose this amount? That's not fear, guys. That's wisdom. That's stewardship. And the Bible teaches us that. All right? So, I know you guys don't know much about trading so far. So, realistically, I would have asked you guys to take some trades just for fun, just so you guys could have the experience of what it's like to take a trade. But you guys don't know about the apps and whatnot to take trades. So, what I want you to do for tomorrow is I want you to go ahead and memorize these, okay? I want you to memorize. Let me write it down for you. I want you to memorize that one tick on ES is equal to $12.50. And that one ES point is equal to $50. Now, I want you to memorize that one tick on MES is equal to $1.50. And that one point on MES is going to be what? I can't even write. It's crazy. 1 point on MES is going to be $5. Oh, iPad is lagging. Okay? So, I'll see you guys tomorrow. There's not much to memorize after all of that. I know it's a lot of information that I distributed today, but tomorrow I will see you guys, and we are going to go ahead and talk about let me see what I have planned for you guys. So tomorrow we are going to go ahead and talk about tomorrow we're going to go ahead and talk about why most traders fail. We're going to have a little bit of a psychology course, okay? We're going to talk about psychology and patience, what happens when you have no system, over leveraging. Okay, we're really going to go over that. It's going to be pretty short because, it's pretty much the basics. But we're going to go over that. And then the next day, on day 5, we're going to go and talk about choosing the right market and broker. Okay, so I'm going to talk about different brokers, and we're going to talk about the different futures market because, as you guys could see, I trade on NASDAQ, I trade on ES. We're going to talk about choosing the right market if you want to trade futures, Forex, if you want to trade indices, gold, and we are going to go over the different, choosing what you want to trade based on your goals. All right? And then we're really going to jump towards the end of the week into understanding candlesticks, market structure, highs, lows, body wicks, bullish, bearish, trends. And we're going to end the week with how to read a chart. So no indicators, just structure, candles, and price action. All right? So congratulations, guys. You guys are almost done with the basic information, halfway through. And so I'll see you guys tomorrow.